Welcome to I Know IFRS Educational Fund Series. It is an initiative of OJ Inspiration Limited. It is dedicated to providing complementary and supplementary education on International Financial Reporting Standard IFRS through a multiple choice question and answer approach. It is intended to make learning or intellectual assurance fun. In this session, we shall be considering 10 questions to which the answers have been provided on IFRS 11. This is the standard on joint arrangements. Viewers or subscribers have 30 seconds to select or choose the answer to each question. Please enjoy it. Question number 1. A separately identifiable financial structure, including separate legal entities or entities recognized by statute, regardless of whether those entities have legal personality, is called dash. A, separate vehicle. B, special purpose vehicle. C, joint arrangement. D, joint operation. E, joint venture. Time counts. Ten seconds gone. 20 seconds gone. Time up. The answer to question number 1 is A, separate vehicle. The statement that serves as the question is the definition of separate vehicle under IFRS 11 joint arrangements. A is the answer to question number 1. Question number 2. In joint arrangement, which of the following parties does not exist? A, joint party. B, joint operator. C, joint venturer. D, party to a joint arrangement. E, none of the above. Time counts. Ten seconds gone. 20 seconds gone. Time up. The answer to question number 2 is A, joint party. In IFRS 11, joint party is a term or terminology that does not exist under joint arrangements. A is the answer to question number 2. Question number 3. A contractual arrangement is least likely to contain one of the following. A, the purpose of the joint arrangement. B, how the board members of the joint arrangement are appointed. C, the capital or other contributions required of the parties. D, how the joint arrangement accounting policy is developed. E, how the parties share profit or loss of the joint arrangement. Time counts. Ten seconds gone. 20 seconds gone. Time up. The answer to question number 3 is D, how the joint arrangement accounting policy is developed. How accounting policy is developed is a matter that is of the least likelihood to be the subject matter of a joint arrangement. D is the answer to question number 3. Question number 4. The contractually agreed sharing of control of an arrangement which exists only when decisions about the relevant activities require the unanimous consent of the parties sharing the control is called dash. A, joint arrangement. B, joint operation. C, joint control. D, joint venture. E, separate vehicle. Time counts. Ten seconds gone. 20 seconds gone. Time up. The answer to question number 4 is C, joint control. The wording in the question is the definition of joint control in the standard. C is the answer to question number 4. Question number 5. A joint arrangement whereby the parties that have joint control therein have rights to the assets and obligations for the liabilities relating to the arrangement is called dash. A, joint arrangement. B, joint operation. C, joint control. D, joint venture. E, separate vehicle. Time counts. Ten seconds gone. Twenty seconds gone. Time up. The answer to question number 5 is B, joint operation. The statement of the question is the meaning of joint operation under IFRS 11. B is the answer to question number 5. Question number 6. A joint venturer generally accounts for its investment in a joint venture at dash. A, cost. B, fair value. C, equity method. D, fair value less cost to sell. E, amount of dividends received. Time counts. Ten seconds gone. Twenty seconds gone. Time up. The answer to question number 6 is C, equity method. Generally, equity method is used to account for investment in a joint venture. Cost basis or fair value basis may be used where exceptions or exemptions apply under IFRS 11 and other reference standards therein. C is the answer to question number 6. Question number 7. A party that participates in but does not have joint control of a joint operation may account for its interest in the following ways except dash. A, recognizing its share of profits. B, recognizing its assets. C, recognizing its liabilities. D, recognizing its expenses. E, recognizing its revenue. Time counts. Ten seconds gone. Twenty seconds gone. Time up. The answer to question number 7 is A, recognizing its share of profits. A party that participates in but does not have joint control in a joint operation is not entitled to a share of profits. Such party does not have joint control, which creates right to the net assets of a joint arrangement, which is inclusive of right to profits. A is the answer to question number 7. Question number 8. A company that brings in an item or property, plant, and equipment into a joint operation, but neither have joint control nor right to the access of the joint arrangements, accounts for the item in line with dash. A, IFRS 10. B, IAS 28. C, IAS 27. D, IAS 16. E, IFRS 11. Time counts. 10 seconds gone. Twenty seconds gone. Time up. The answer to question number 8 is D, IAS 16, which is the standard for property, plant, and equipment. IFRS 11 provides that if a party without a joint control that participates in a joint operation does not have rights to the asset relating to that joint operation, it shall account for its interest in the joint operation in accordance with the IFRS applicable to that interest. D is the answer to question number 8. Question number 9. One of the following is not an element of the definition of joint control. A, contractually agreed. B, sharing of control. C, relevant activities. D, unanimous consent. E, separate vehicle. Time counts. Ten seconds gone. Twenty seconds gone. Time up. The answer to question number 9 is E, separate vehicle. All other options are components in the definition of joint control. E is the answer to question number 9. Question number 10. When a company that is a joint operator buys a non-current asset from joint operation, it is part of and the asset remains in its custody. Which of the following holds? A, the company recognizes its share of the gain, but not the loss arising. B, the company recognizes its share of the loss, but not the gain arising. C, the company recognizes its share of the resultant gain or loss. D, the company nets the asset bought from its joint operation contributions. E, the company does not recognize its share of the gain or loss. Time counts. Ten seconds gone. Twenty seconds gone. Time up. The answer to question number 10 is E. The company does not recognize its share of the gain or loss. A joint operator is prohibited from recognizing its share of gains or losses arising on its purchase of assets from the joint operation until such assets are sold to third parties. E is the answer to question number 10. That is all for this set. Thank you for joining us for the set 1 of IFRS 11 joint arrangements. We invite you to subscribe to our channel, share our links, and invite those in your network to do the same. This will enable you and all other subscribers get direct notifications on future video uploads. We intend to cover all of the standards in this framework and create further sets of question and answer on standards already covered. For collaborations in this area, please call or WhatsApp +2349 03077 0109. Bye for now.